Mortgage insurance can be as little, if you put 5% down on a home, the mortgage insurance could be anywhere from, $80 to $190. There's a lot of strategies geared around being self-employed and how do we go about showing income on paper through your tax returns to allow you to be eligible. If I was able to get a hold of people before they even thought they were ready, right, I could work on taking a look at their income, what we need to do to adjust that if they're self-employed like we were talking about earlier. I have ways to help improve their credit scores. Rates and cost of rates are determined, one major factor is your credit score.
Hey, good morning. Welcome to TAP. And we're here today to Paul Sammons from Shamrock Loans, CMG Home Loans. And we're so glad that you joined us. So thank you for joining us, Paul.
Thank you for having me this morning.
And as always, we're trying to communicate what our value is to both Paul's clients as well as mine, and understanding a little bit more about the mortgage industry and how it's been affected in these last couple of years, and then what we see going forward. So, Paul, just to start off, tell us a little bit about some lending considerations that a lot of clients don't understand or think there may be myths associated with getting a home loan.
Sure. The biggest one that comes to mind is this idea of, down payment and PMI, mortgage insurance, right? A lot of my clients think that you have to put 20% down to buy a home, and they're so classically conditioned that PMI is this big, nasty, ugly thing. When you break it down, it's really not. I mean, the best example I can give you is mortgage insurance can be as little, if you put 5% down on a home, the mortgage insurance could be anywhere from, $80 to $190. It's not a month. It's not a massive, big, scary thing. Now, PMI has to do with your credit score and profile. It has to do with the loan amount. And there's various considerations that go into what your specific PMI mortgage insurance number would be at a certain percent down. But it's not as scary as people think, because if you think about it, a lot of the clients that we've done recently, I mean, I've refinanced people 6 months or so after we closed a new home purchase loan. And these are people that are putting less than 20% down. So in reality, you always marry the house, but date the rate, is what we say in this industry, right? So you're not going to be in your original home loan typically for 30 years, right? I mean, if you were buying when COVID was going on and you were getting a 2.9% interest rate, you probably don't want to refinance that anytime soon. But with rates where they are, we're doing a lot of work to where you can get rid of PMI with refinance sometimes, right? So as the more equity over time goes into your house, that goes up. You pay down your mortgage. So over time, your PMI is going to go away with it either refinancing or having the lender directly take it off when you hit a certain loan to value. So I would say the biggest misconception is, the best example I can give you on that, Art, is if a $500,000 purchase price on a house and you put 5% down, $25,000, right? So if you were to do 10% down, 5% more, that's another $25,000. That's probably going to save you $50 a month in PMI. Gotcha. 5% to 10% down is probably. So if somebody walked up to you in the street and said, "Give me $25,000 and I'll save you $50 a month,"
would that be worth
your time? So that's the best, everybody, when you think of it that way, it's like, I'm not giving somebody 25 G's to save $50. So It's not a big scary thing. So I would say the biggest misconception is you don't always have to put 20% down. PMI is typically not $300, $400, $500, $800 a month. It goes away soon. Save your money. Use it to buy other properties or work on your home or pay off other debts. You don't need to sink all that money directly in at the start of a loan.
And one of the things that we're seeing in the industry is that, to your point about refinancing after your home is increased in value, we're seeing values of homes increasing in this area 4 to 6% per year, year over year. So it doesn't take very long before you're already starting to see that value and you're able to refinance.
No, that's spot on too. And we're able to there's a couple instances on some of our houses that we've done together as clients.
More
where
than
clients
10%.
have put 10% down, and in 6 months,
Right.
when they send an appraiser back out there, not only are they reducing their rate, but they're getting rid of PMI,
True. Yeah.
right?
Right.
So it's not a scary thing, as people think it is, Art.
Great. Another question for you I would ask is, how are life transitions affecting borrowing power?
Yeah, sure. So, a lot of my clients come to us looking to buy a house because of one of these, right? You're talking about a divorce or someone having a kid or custody of kids or finances or having to pay child support or alimony or
Downsizers, maybe folks that are looking to get out of a multifamily house or a big single family home and they are now downsizing. How do those kind of things affect their borrowing power?
Yeah, it can. Depending on their situation where, a lot of times people are trying to refinance someone out of a house or trying to get somebody that they want to qualify on their own. So typically what people don't consider sometimes is if, you're a husband and wife, for example, that's two co-borrowers. If they both have a full-time job, we want to be able to use all that income. If somebody's trying to buy somebody out of the house because of a divorce or something that comes up, they need to be eligible on their own. So just because you were necessarily eligible when you were a couple or together as one doesn't mean you're going to be able to do it on your own. So there can be various factors that come into play when considering what you're eligible for related to, life events.
Yeah, that's great. That's great. Some of the other things that, you mentioned already, divorce, self-employment, for example.
Sure.
Someone that's self-employed, it's a 1099 employee, not a W-2 that goes to work every day. They're self-employed. What are some of the considerations associated with a self-employed?
Yeah, that's a good question. So self-employed, you typically need to be self-employed for at least 2 years to use your self-employment income. Okay. Now, if you've been in business for at least 5 years self-employed, you're able to use the most recent tax return filed for consideration to be eligible, as opposed to the most recent 2 years filed tax return. Because if they take an average of the 2 years, typically that can be lower than just using the most recent tax return. So when it comes to that, there's an algorithm, if you will, to determine, we just don't look at your tax returns and see what your gross wages are, and that's your eligible income. That's not how it works. There's depreciation on a tax return on the schedules. There's different buckets, if you will, that, you can get taxed on all that stuff, or you can kind of minimize your tax burden. So what's interesting with self-employed, like I've done loans for like barbers or hairstylists or, bartender managers where, they don't report a ton of income.
Try to write as much off as they can, right?
Which is smart.
Right.
Which is smart, unless you're trying to buy a house, right? So a lot of it's interesting where if you're self-employed, the earlier you can kind of sit down and evaluate that, the better. Because right now it's interesting. I'm doing a lot of pre-approvals for clients that are self-employed, and I'm strategizing with their CPA, with their accountant, prior to them filing, right? So I say, hey, let's get a draft of your 2025 taxes before you submit them, so we can kind of help evaluate on where to maybe move categories and buckets. Because when it comes to Fannie and Freddie and getting loans, you can add back in depreciation, and there's, you're going to have to take a tax hit if you're self-employed and you want to buy a house, probably more than you've been doing before. But it's a good question, because there's a lot of strategies geared around being self-employed and how do we go about showing income on paper through your tax returns to allow you to be eligible.
Right, that makes sense. And that kind of takes me to the next question around timing. Like, when is a good time to come to you, particularly for self-employed folks or even for first-time home buyers who might think they have a whole lot of debt and may not have as much as they think in relationship to purchasing the house? How does timing work?
That's a good question.
In that process.
That's a good question. The wrong answer is when they're ready. The right answer is when they don't think they're ready. And let me tell you what I mean by that. The earlier you can get to me, the more research I can do, and the more, looking forward, I can help you plan a game strategy around. So, I've had people come to me and say, hey, Paul, I've been thinking about this for a year. I want to get pre-approved. Thank you for thinking of us, and I'd be glad to help you. But then after I look at all their data, we're looking at assets, we're looking at income, we're looking at credit scores, we're looking at not only credit scores, but your credit profile, right? A lot of those things go into determining that. And if I was able to get a hold of people before they even thought they were ready, right, I could work on taking a look at their income, what we need to do to adjust that if they're self-employed, like we were talking about earlier. I have ways to help improve their credit scores. Rates and cost of rates are determined, one major factor is your credit score. And there's different tiers, different buckets, if you will, where 660 gets you a certain rate, 680, 720, 750, and there's different tiers and categories. So, if someone comes to me and they think they're ready to buy and they're at like a 680, if I would have talked to them a year ago or 6 months ago,
as to how to better improve that score to make them a whole lot more.
You got it. And to what you were saying earlier, same thing if they were self-employed. If we have to take a 2-year history and they talk to me a month after they filed a previous year's tax return,
that ship sailed
like fiddlesticks.
Yeah. Okay.
You should have got a hold of me. So I think that the earlier, even if you're a year out, you think you're a year out, 2 years out, the sooner we can help strategize and game plan and put you in the best position possible to be able to buy, the better.
Good.
Coordinated planning around putting in an offer, for example.
Sure. Okay. Yeah.
So, when we have clients that we are working with collaboratively, how do coordinated plans, particularly in finding out what's the best strategy in order to put my client's best foot forward and your client's best foot forward to get that deal? How is coordination important in that?
Yeah, well, I mean, it's these days, you need a dream team around you these days to get some of these offers accepted, right? I mean, it's with these buyers and, a couple of the little things I do, and we've done this a bunch to where when we submit an offer to an agent, I want to reach out proactively to the listing agents. A lot of loan officers don't proactively do that. Typically, the listing agent, if they sift through a couple offers, they'll pick the one or two they think is good, and then they'll call and reach out to validate who this person on the other line is. I think it's very strategic that listing agent feels confident in who's going to be on the other side with the loan, because all they have is a pre-approval with somebody's name on it. They don't know me from a hole in the wall. Right. So, it's really important to establish that we're doing our due diligence to ensure them that the finances are strong. We do pre-underwrites. One of the things and strategies that we do too is where we almost try to have the loan done in a sense before it even starts, right? So I'm gathering W-2s, pay stubs, tax returns. I'm getting all that pre-underwritten, it's called, to ensure that, we can honor our commitment dates, we can honor a quick close, and we can show the listing agent that we're in a position where we've already vented all the documents that we've needed to, for the most part. You can't do everything on the front end, but you can do a lot of that workload to ensure the listing agent is feeling confident in our offer. And, also too, it's like, you don't hear from some of these loan officers after that. It's they kind of ghost, but I try to ensure that the listing agent is in tight communication moving forward when we start a loan process, and just ensuring all parties are involved with that.
That's great. So lastly, I would probably ask, what's the one thing clients should do before applying for a loan?
Yeah, well, a couple right off the bat. Don't open any new credit. Don't go out and buy Lamborghinis and Ferraris. It's so funny. I just pre-approved a client last week who just bought a car. He didn't need a new car. He wanted a new car. But if he would have talked to me a couple weeks ago, I don't think he would have made that purchase, or he would have held off, because it was a $500 a month payment, So don't open any new debt, even if it's small. You don't want to be
even a store credit card or a
Best Buy card.
Best Buy.
Yes. Don't open new appliances.
Buy furniture for the new house that you just put your eyeballs on. right?
It's so true. Get evaluated first. Don't open any new credit. Changing jobs is kind of a thing that can or cannot hurt you. It depends on what your income is, and if your base salary versus hourly. So I would say don't open any new credit, and maintain your job, or look to do something in a similar industry that's paying you a similar pay.
Right. Great.
That brings up a good point about when we're pre-approving somebody, one of the things that people don't understand when I pre-approve them at first is how income is qualified, how we determine what your eligible income is. If you have a base salary job, that's pretty darn easy, right? You just take your debt to income ratio is determined by your monthly income versus your monthly debts. People with the base salary, that's pretty straightforward. If you have somebody that's hourly, okay, and works full time, everybody has different preconceived notions on what full time means, right? Typically, you have to take a 2-year average of hours worked
for an hourly
employee. And some people don't. It's like when I ask, one of the things I ask from people when I'm pre-qualifying is if they're hourly, is a year-end pay stub. Mm-hmm. And half the time they send me a W-2.
Right.
Okay. W-2 doesn't break down the hours you worked over the course of the year. Right. So those year-end pay stubs show year-end totals to where, a lot of people, when they talk to me, they're like, well, I make 40 hours, I work 40 hours a week and I make this hourly. But then you break it down. Well, actually, you're averaging about 34 hours a week, not 40. Right. So it's really important to be accurate and diligent in pre-approving somebody when they're hourly versus salary. Right.
How about folks that are, that work on a bonus?
Yeah, good question. Bonuses come into play where you can use a bonus if you have a 2-year history of receiving the bonus, and it's likely to continue. So typically, likely to continue, which is, meaning, usually they need to have validation or an employer letter or something states that the employee is in good standing and that, this is likely to continue on based on the work they're doing, right? If they're, leaving in 6 months, then, I don't think an employer is going to, write that off. Same thing with commissions, right? Bonuses or commissions are treated similar to where you can use commissions as long as you have a 2-year history of it.
Gotcha.
And it's likely to continue.
Super.
Paul, tell us a little bit about, are there any unique loan products that you have out there in your quiver that you can help clients with that can separate you from other loan officers, and how it makes you unique?
Yeah, absolutely. I would say one product I'm doing a lot of these days is what's called a DSCR loan. I think we've even done a couple of those or talked about a few debt service loans where if you can prove that you have at least 1 year of landlord experience is the initial qualification of this. Now, meaning you've, rented out a place that you've owned, you've had, places that you've been a part of in the past where you've rented out, any situation where you've been a landlord on a place that you've owned or currently own, right? You have to prove that you've been a landlord for at least a year. The unique thing about this loan and why it's good is it's not for first-time home buyers. You can't be a first-time home buyer, right? You have to have already had an established house that you've rented out and can show on tax returns that you're receiving rental income on. If you are, you can purchase a home without considering any of your income, which is huge, right? So it doesn't matter if you work or not, is how you can get qualified for this loan. How it works is essentially the monthly rental income of that property has to be more than the total monthly mortgage payment. So if the fair market rental income of that property, let's say it's a 3-family, the appraiser goes out there, right? Because it's a multi, and he'll assess what his fair market rental income value is for those 3 units in that house. Typically, you have to put, if it's a single family, I think you can get away with 15% down on a DSCR. If it's a multi, you're moving into the 20% range or more. But as long as you have the down payment and the rental income is going to be more than what the monthly mortgage payment is, you're essentially qualified. And I've had a couple clients where they're on their 5th loan with me, where they got their initial new home purchase loan, has a family, lives in it, bought an investment property after that, had it for a year, and then over the course of the next 2 years, bought 3 investment properties with this DSCR loan. It's very easy to underwrite because you're essentially just sitting and waiting for an appraisal to come back.
Right.
I mean, you have to get, you have to run their credit, right? You have to have a credit profile and a credit score to be eligible. But that is, and down payment, you have to have the funds. But you can take advantage of that tenfold if you become a landlord.
What a great way to be able to build generational wealth and passive income flow using, your example that you used, somebody who bought a first time home buyer, then bought their first investment property, and then is able to then leapfrog into 3 more investment properties that are creating positive cash flow and putting money in their pocket while they're sleeping.
It's
a great way to
it's so good.
Yeah.
I'm looking at some of my clients like, man, I should practice what I preach. Like, I should have 5, but it's a great thing. And something I really rally behind, particularly if somebody already owns a property and is looking to get another one. So that's a great one. I think another one worth mentioning would be like asset-based loans and bank statement loans.
Okay.
Right.
A little bit more about that.
Sure. So similar to where you don't have to take into consideration your employment, your income that you receive from your job. It's strictly based on what your assets are if you're self-employed. So if, entrepreneurs, self-employed borrowers that have, business banking statements are typically really good candidates. So a lot of times, owners, like we were talking about earlier, self-employed owners don't really have W-2 wages a lot of times. They don't pay themselves weekly or bi-weekly, right? They have assets from the organization that they funnel through their tax returns and that filter through their schedules on their tax returns. So that's no problem. What they do have, though, is typically they have a business bank statement or a couple business banking accounts to where they're funneling all of their activity in their business through these accounts. Invoices, services paid, outgoing to their vendors, incoming, and they have, typically a lot of money filtering in and out of this account. With those statements, we can get you eligible to purchase a property just based on your bank statement activities and a still down payment, still credit score, still credit profile. But you don't need to be considered based on your W-2 wages.
Right. So that's a huge proportion of our community, right? Our small business owners, restaurant owners, landscapers, plumbers, electricians. There are a lot of people that are self-employed that could take advantage of a loan like that.
Yeah, and absolutely. And to your point, Arthur, a lot of the good loan officers will, obviously, let's take a look at your tax returns and see what 1 year or 2 year averages you have with your, net income after all the things have been backdated on your schedules. But if that doesn't work, it's nice to be able to have more solutions for these types of buyers.
Right.
And
or I was in that quiver, right? For you to be able to help our clients. So appreciate that.
Yeah, you got it. You don't necessarily have to have, steady income to get eligible for some of these loans.
Perfect. That's great. Well, thank you, Paul.
Those are good.
Yeah,
those are
great
good questions.
And truly appreciate you being here with us today and sharing some of your perspective and knowledge. And as a trusted advisor, you're one of the most responsive and accurate lenders that I work with, and I'm truly privilege to work with you.
Thank you, sir.
And looking forward to continuing to do that. So, Paul
Thank you,
Sammons from Shamrock CMG Home Loans. If you're in need, he's definitely a resource that you need to reach out to.
Appreciate it.
Thanks for joining us today.